In May 2023, Porsche was worth $120 billion, more than Ferrari, Mercedes, even Volkswagen, its own parent. But that value was built on cars it hadn't sold yet. By 2025, profit collapsed 98%. First quarterly loss ever, kicked out of Germany's top index. Porsche didn't get outsold. It got outvoted in its own boardroom. So how does the most profitable car company on earth lose everything in 3 years? The golden goose. For decades, Porsche was the quiet superstar buried inside the Volkswagen Group. VW makes the Golf. VW makes the Jetta. VW sells millions of cheap, practical cars every year on razor-thin margins, sometimes as low as 3 or 4%. Porsche did something almost nobody else in the industry could pull off. It regularly posted operating margins above 15%, some years close to 18%. For context, that's Ferrari territory, on a brand that also makes SUVs and sedans, not just six-figure supercars. Porsche was, quite literally, the most profitable car company on earth relative to its size. Every 911 that rolled off the line in Zuffenhausen was basically a cash machine. And Volkswagen knew exactly what they had. For years, Porsche quietly subsidized the rest of the group. When VW needed capital for a new project, Porsche was often the answer. But by 2022, Volkswagen had a much bigger problem than funding one plant or one platform. The entire auto industry was racing toward electrification, and that race costs an unbelievable amount of money. Battery factories, new software platforms, entirely new supply chains for parts nobody had ever mass-produced before. VW needed tens of billions of euros to fund that transition across its 10 different brands. And someone came up with a plan. Why not take the crown jewel, the most profitable brand in the portfolio, and sell a piece of it to the public? That's how we got to September 2022, the Porsche IPO, the biggest listing on the German stock exchange in more than 25 years. Volkswagen sold off a slice of Porsche AG and raised 19.5 billion euros in a single day. Porsche was valued at roughly 75 billion euros, around $72 billion, right out of the gate. It was already bigger than Ferrari. It was one of the largest car company valuations in the world, and it hadn't even opened for a full week of trading yet. The $120 billion BET. Here's a rule worth remembering before we go any further. A stock price isn't a report card on how good your cars are. It's a bet on the story you're telling about the future. And investors weren't just buying Porsche's past, they were buying Porsche's electric future. Because the moment Porsche went public, the company doubled down on an incredibly aggressive promise. 80% of all Porsche sales would be fully electric by 2030. Not hybrid, not a mix. 80% battery electric in less than a decade for a brand whose entire identity was built on the sound and feel of a high-revving flat-six engine. To Wall Street, this sounded brilliant. Porsche already had proof of concept. The Taycan, launched in 2019, was the brand's first all-electric car, and it was a genuine engineering achievement. A Porsche that could out-accelerate a 911 in a straight line while somehow still handling like a Porsche. Early demand looked promising. Analysts loved the story. A legacy luxury brand, successfully making the leap to electric, keeping its premium pricing, and doing it without losing its soul. That narrative, more than any spreadsheet, is what pushed the stock to its all-time high of just over 120 euros a share in May of 2023, a market valuation north of 110 billion euros, well over $120 billion at the time. Porsche, on paper, was worth more than the parent company that had just spun it out. But here's what nobody wants to admit when a stock is on a tear. Nobody was actually stress testing the plan. Nobody was asking the obvious question. What happens if the people who buy Porsches don't want an electric Porsche as fast as the spreadsheet assumes? Cracks in the dashboard. The first sign of trouble came from the car that was supposed to prove the whole strategy worked, the Taycan. After a strong launch, Taycan sales started sliding hard. By 2024, deliveries were down 49% year over year. Almost half the buyers gone in a single year. Part of it was increased competition. Chinese manufacturers were now building genuinely quick electric sedans for a fraction of the price. But part of it was something simpler. The kind of person who buys a Porsche sedan wants a Panamera with a screaming V8, not a battery pack, and Porsche had misjudged just how many of its own loyal buyers felt that way. Then came the Macan. This is the car that should have been the easy win. The Macan is Porsche's best-selling model worldwide, the practical everyday SUV that funds the fun stuff. Porsche's plan was to kill off the gas-powered Macan in Europe entirely and replace it with an EV-only third generation. Except the software wasn't ready. The Macan Electric got delayed by nearly 2 years because of problems inside CARIAD, Volkswagen's in-house software division, the same division responsible for building the digital backbone for half the Volkswagen Group's future vehicles. Porsche ended up scrambling to keep the old combustion Macan alive far longer than planned, just to have something to sell showroom customers while they waited. And then there was the battery. In 2021, Porsche proudly broke ground on its own battery cell factory through a subsidiary called Cellforce, based in Kirchentellensfurt, Germany. The pitch was simple: build high-performance battery cells in-house, the same way ambitious EV makers around the world were racing to control their own battery supply. It was framed as a statement piece, proof Porsche was serious about the electric future. By 2025, that statement piece was quietly being wound down. Porsche admitted there simply weren't the economies of scale to justify producing its own cells. On top of that, Porsche had bet on a startup called Northvolt to supply cells for the upcoming electric versions of the 718 Boxster and Cayman. Northvolt went bankrupt. Those electric sports cars, which were supposed to launch by the end of 2025, got pushed back, with no clear replacement supplier lined up in time. One delayed flagship EV, one failed battery supplier, one in-house battery factory that made no financial sense. Individually, these look like normal growing pains for any company chasing new technology. Stacked on top of each other in the span of about 2 years, they started to look like something else entirely. A company that had made a promise it wasn't actually built to keep. The China reckoning. If there's one market that exposed exactly how fast the ground had shifted under Porsche's feet, it's China. For years, China was Porsche's golden market. Back in 2021, Porsche sold more cars in China than in Europe or the US. Chinese buyers loved the badge, loved the exclusivity, and were happy to pay a serious premium for it. Porsche built its entire electric strategy assuming that appetite would carry straight over into EVs. It didn't. While Porsche was still finalizing its electric roadmap, Chinese manufacturers were already several steps ahead. BYD, NIO, and especially Xiaomi, whose SU7 sedan launched with genuinely impressive performance, cutting-edge software, and a price tag that undercut a comparable Porsche by a massive margin. These weren't cheap knockoffs anymore. They were legitimately advanced, tech-forward electric cars, built by companies that Chinese consumers were starting to trust more than legacy European brands. The results were brutal. Porsche's China deliveries fell 21% in a single quarter in 2025. By 2026, that number had ballooned into a 56% collapse in China sales year over year. Porsche tried discounting the Taycan heavily just to clear dealer inventory, but that created its own problem. Nothing erodes a luxury brand faster than showing up in the news for slashing prices. European sales fell 18%. North America dropped 11%. This wasn't a China-only story anymore. It was global. And here's the uncomfortable truth underneath all of it. Porsche kept blaming slowing EV adoption for its problems. But in China, of all places, electric vehicles had already crossed 50% of the entire market. EVs weren't the problem. Porsche's EVs were the problem. All right, before we get into how bad this actually got on the balance sheet, if you're enjoying this deep dive into what's really happening behind the scenes at some of the biggest names in the car world, do me a favor and hit that like button. Drop a comment telling me what car company you want us to break down next, and if you haven't already, subscribe and tap the notification bell so you don't miss the next one. It genuinely helps this channel grow. Okay, back to the story. because this is where things get ugly fast. 4 warnings and a free fall. Here's a rule that applies just as much to car companies as it does to any other business. You can't sell exclusivity and chase volume at the exact same time. Porsche spent 100 years building its name on scarcity, precision, and a very specific kind of customer. Then it tried to simultaneously scale up EV production, satisfy a parent company's group-wide profit targets, and keep that same aura of exclusivity intact. Something had to give. Throughout 2024, Porsche issued not 1, not 2, but 4 separate profit warnings. 4 times in a single year, the company had to go back to investors and say, "Actually, it's worse than we told you last time." That kind of repeated backtracking destroys confidence fast. By the end of the year, Porsche's stock had lost more than 30% of its value, and the company was demoted out of Germany's DAX, the index reserved for the country's 40 largest publicly traded companies. Think about that for a second. A company that had been valued at over $120 billion less than 2 years earlier had shrunk so much it no longer qualified for its own country's blue-chip index. Then came the quarter that made headlines everywhere, Q3/2025. Porsche posted a loss of roughly $1.1 billion, its first quarterly loss since going public. A year earlier, that same quarter had produced nearly $1 billion in profit. The swing was almost $2 billion in a single year on a single quarter. Porsche's CFO called it extraordinary expenses, which is corporate language for, "We're paying right now for the mistakes we made chasing electric too fast." By the time Porsche closed the books on 2025, the full picture was staggering. Operating profit for the year, 413 million euros, down from 4 billion euros the year before. A 93% collapse. Inside that number, Porsche's core automotive business alone had absorbed a 3.9 billion euro charge, tied almost entirely to reversing its EV strategy. Writing down platforms, canceled programs, and battery investments that were never going to pay for themselves. Operating margin, the number that used to sit proudly above 14%, cratered to around 1%. There's an old line from the world of business strategy that fits perfectly here. The essence of positioning is sacrifice. You cannot be everything to everyone. Porsche tried to be the electric future and the analog past at the same time, without ever clearly telling its own customers or its own factory workers which one actually came first. And when a 100-year-old brand loses its sense of what it actually is, the market punishes it instantly. The fallout reached all the way to the top. Oliver Blume, who had been running both Porsche and the entire Volkswagen Group at the same time, faced growing criticism from investors over that exact dual role. How can you steer Porsche's own turnaround while simultaneously managing every other brand in the portfolio pulling in different directions? In early 2026, Blume stepped down as Porsche's CEO. In came Michael Leiters, previously the head of McLaren Automotive, brought in specifically to stop the bleeding and figure out what Porsche actually was, before it tried figuring out what Porsche wanted to become. The Great Reversal. What happened next was one of the most dramatic strategic U-turns the auto industry has seen from a major manufacturer in years. Porsche scrapped its own battery factory entirely. Cellforce, the subsidiary that was supposed to be Porsche's answer to the battery supply problem, got shut down completely, just 5 years after Porsche broke ground on it with fanfare. Porsche e-bike Performance, an electric bike joint venture the company had built out as part of its broader lifestyle diversification, got closed in the same week. Porsche also sold off its stake in Bugatti Rimac, walking away from one of its more ambitious side bets. Leaders put it about as plainly as a public company CEO ever does. We must refocus on our core business. The 718 Boxster and Cayman electric versions, originally promised for 2025, got pushed all the way out to 2027. The K1, Porsche's planned electric flagship SUV positioned above the Cayenne, got delayed to around 2029, and it may not even launch as a pure EV anymore. Combustion and plug-in hybrid options are back on the table for a vehicle that was originally supposed to be a statement of Porsche's all-electric future. And the Macan tells the whole story in miniature. Remember, the plan was to kill the gas-powered Macan entirely and go electric only. Instead, in the first half of 2026, the combustion Macan actually outsold the electric Macan by more than 4,000 units in markets where buyers still had the choice. The car Porsche tried to phase out was still winning against the car it was supposed to replace. The company also confirmed it will eliminate roughly 9,000 jobs by 2035, about 1 in 5 of its entire workforce, on top of thousands of temporary and contract positions already cut. Even the 911, the crown jewel, the one car Porsche said would never be forced electric, is now getting more hybrid technology rather than a full battery electric future. A quiet but massive retreat from where the company said it was headed just a few years earlier. Here's what's almost darkly funny about all of it. In that same brutal stretch, while the EV lineup was collapsing, the 911, the oldest, most old-school, most stubbornly combustion-powered car in the entire lineup, grew 19% in deliveries, driven by demand for the high-performance GTS, Turbo, and GT variants. The car, built on a formula from 1963, was outperforming the cars built for 2030. So let's go back to where we started, $120 billion at the peak, in May of 2023. And less than 3 years later, profit essentially wiped out, the stock cut by more than half, kicked out of its own home stock index, and a company laying off 1 in 5 of its own employees to pay for a strategy. It's now unwinding piece by piece. What actually happened here wasn't that electric cars failed, and it wasn't that Porsche lost its engineering edge. The 911 proves the engineering was never the problem. What happened is that Porsche, under enormous pressure from its parent company's group-wide electrification goals and a red-hot stock market story, moved faster than its own customers were ready to move. It built a battery factory before it had proven demand to fill it. It tried to kill off gas-powered versions of its best-selling car before the electric version was even ready to stand on its own. It chased a China market that had already moved on to homegrown competitors building faster, cheaper, and smarter than Porsche expected. Porsche didn't get erased. That's the important distinction. Unlike some brands that collapse and disappear entirely, Porsche still has the most valuable thing any car company can own, a genuine, undiluted identity that customers actually believe in. The 911 still means something. That's exactly why it's the one model that kept growing while everything else around it fell apart. The brand's core is still intact. What broke was the story layered on top of it. The promise that Porsche could sprint toward an all-electric future on someone else's timeline and still be Porsche when it got there. The lesson here isn't that electrification is doomed. Porsche's own EVs, the Taycan and the Macan Electric, are still, by most measures, genuinely excellent cars. The lesson is that no brand, no matter how prestigious, can outrun the people who actually buy its products. You can build the fastest electric sedan in the world, but if your buyer wants the sound of a flat 6 wailing to 8,000 RPM, no spreadsheet in Wolfsburg is going to change their mind on your timeline. Porsche bet $120 billion that it could, and it's still paying for that bet today. And that's the real story behind one of the wildest financial roller coasters in modern automotive history. A brand that went from the crown jewel of the Volkswagen empire to a $120 billion stock market darling, to laying off 1 in 5 of its own people just to survive its own ambition. If you learned something from this one, that's honestly why we make these videos here at Motor Zen. We love this industry, warts and all, and we think understanding the business behind the cars actually makes you appreciate the cars themselves even more. So if you haven't yet, hit that subscribe button and turn on notifications so you catch the next deep dive the moment it drops. And I want to hear from you. Do you think Porsche made the right call pulling back from EVs? Or do you think they panicked too early and just handed the future over to companies like BYD and Xiaomi? Drop your take in the comments. I read every single one, and honestly, some of the best insight on this channel comes straight from you guys. If you want to see how another legendary brand nearly destroyed itself chasing the wrong bet, check out the video right there on your screen. It's one of the wildest business stories we've covered on this channel. Thanks for watching, and I'll see you in the next one.